This is an analysis from Alpha Business Media.
Welcome to the deep dive. So, if your focus this year has been on the usual suspects, inflation, interest rates, the trade deficit, you're not alone.
Not at all. It's where most of the conversation is.
But our sources suggest that this focus, while it's necessary, it's also dangerously incomplete for charting what's ahead.
Right. We need to look beyond the standard playbook. Those risks are more or less priced in. The mission today is to move past those textbook worries.
And really dissect three high-impact, low-probability events. True black swans, you could say.
Exactly. They're gathering strength just over the horizon of the usual risk models.
And that's the key point here. These aren't just abstract global fears. We've zeroed in on three systemic risks that have direct, very clear transmission channels straight into Nepal's economic pillars.
We're talking about remittances, logistics, and our capital markets.
If any of these hit, they won't just cause a slowdown. They'll fundamentally change the game for every CEO and policymaker listening.
So we've distilled the material into three core threats. First, a sudden liquidity crunch in the massive global private credit market.
Okay.
Second, a serious geopolitical conflict breaking out over the new Arctic trade routes.
And the third?
The algorithmic fragility. It's a new danger in AI-driven high-frequency trading.
And the common thread here?
The thing is, they are all external, non-monetary shocks. You can't just raise or lower interest rates to fix these. They demand a completely new way of thinking about risk.
Okay, let's unpack that. Let's start with the most opaque one our sources call the shadow supernova. I think to get this, you really have to understand where this whole private credit market came from.
It's a fascinating story, really. It's a product of regulatory arbitrage born right out of the 2008 financial crisis.
So after 2008, regulators cracked down on the big banks.
They forced them to shore up their balance sheets, pull back from riskier corporate lending. But that demand for credit, it didn't just vanish.
Yeah, it had to go somewhere.
Exactly. It was filled by non-bank entities. Think private equity funds, pension funds, huge asset managers. They stepped in to provide loans directly to corporations, completely outside of traditional banking oversight.
So instead of going to a regulated bank, a company just goes to a massive private debt fund, and that market has just ballooned.
Oh, absolutely massive. By the time 2025 came around, we're talking about assets under management hitting $2.1 trillion globally. This thing is basically a shadow banking system for the entire world.
Yeah, the sources draw a really powerful analogy. They compare this huge global market to a macro version of Nepal's own less regulated cooperative sector.
Yeah.
But for corporate debt. Why is that comparison so apt when we talk about risk?
Because the failure mechanism is identical. It's all about illiquidity and hidden leverage. A traditional bank loan, you can often sell it. The collateral is clear. Private credit loans are bespoke.
They're custom made.
Right, and you can't just sell them on a secondary market. They're fundamentally illiquid. So if the global economy slows down and these corporate borrowers start to default,
the investors who put money into these funds, pensioners, sovereign wealth funds, they're going to want their money back fast.
They'll panic. And you get a flood of redemption calls.
And the funds holding these illiquid, now defaulted loans, they can't raise the cash to pay everyone back.
That's the liquidity mismatch. It's a bank run. But the crucial difference is there's no central bank, no lender of last resort to step in. The only move they have is to freeze all new lending and try to dump assets.
And that freeze is the shockwave that travels all the way to Nepal.
Yes.
So how does a corporate debt freeze in, say, New York or London actually hit a household in rural Nepal?
It's the primary channel, remittances, the lifeblood of the economy. Think about the millions of Nepalese working in the Gulf, in Malaysia. They're not usually working for huge, publicly traded multinationals.
Oh, they're in mid-sized construction, services, logistics.
Exactly. And many of those firms are highly dependent on the very kind of high-yield funding that this $2.1 trillion private credit market provides.
So when that global credit tap is turned off, the projects they're working on starve for capital.
Precisely. You see mass layoffs, immediate project cancellations across all the key employment hubs. Our analysis points to a sudden, maybe 15 to 20% contraction in remittance inflow.
And you have to remember the scale here. We're talking over 1.3 trillion NPR last fiscal year. That's nearly a quarter of GDP. A 20% drop is It's catastrophic.
It's an immediate shock. It doesn't just cut household spending, it instantly blows a hole in your balance of payments and threatens to just decimate your foreign exchange reserves.
But you also mentioned a secondary channel, one that hits our own financial system here at home.
Yes, the domino effect. Foreign direct investment for our big infrastructure projects, especially hydropower, a lot of that money is raised through these same international private funds.
So global freeze means disbursements just stop.
They halt immediately, leaving half-built dams and transmission lines stranded.
And our local banks are left holding the bag.
Your Class A commercial banks become the co-financiers left exposed. They're stuck with non-performing loans on projects that aren't generating a single rupee of revenue. So the crisis starts in global corporate debt, but it morphs into a domestic banking crisis.
Wow. It's a direct threat to both our main source of foreign currency and our banking stability.
Yeah.
Really forces you to ask, what do you do when the system that's supposed to see these risks can't even see this one coming?
It reframes the whole idea of financial risk.
Okay, let's pivot now. From finance to geopolitics and climate change, this next one is called the polar vortex. On the surface, it seems like an environmental story, but it gets really interesting for supply chains.
Yeah, the melting Arctic sea ice isn't a problem for the future anymore. It's a live geopolitical contest right now. The opening of the northern sea route along Russia, the Northwest Passage through Canada, I mean, these can cut Asia-Europe transit time by up to 40%.
The economic prize is enormous.
It is. We saw record cargo transits just last year, backed heavily by Chinese and Russian interests.
But the Black Swan here isn't the melting ice. It's the conflict over who controls this new global highway.
Absolutely. The conflict it's rooted in international law. Russia claims sovereign control over its route, the NSR. They want to charge fees, require permits.
But the U.S. and its allies say no, that's an international strait. Freedom of navigation.
And then you have China aggressively positioning itself as a near-Arctic state, investing billions in icebreakers and resource exploration.
So what happens if tensions boil over? A blockade, a naval standoff.
The whole region becomes uninsurable, instantly. The second Lloyd's of London won't underwrite the risk, commercial shipping just stops. And that triggers the logistics shock for a landlocked country like Nepal.
Wait, we don't ship anything through the Arctic, so why does that matter to us?
Because global shipping capacity is a zero-sum game. If the Arctic routes slam shut, hundreds of massive container ships have to divert somewhere.
They're the only other options. The Suez and Panama canals, which are already congested.
Exactly. So you get this massive, immediate surge in demand for the limited capacity on the old routes. And that causes global freight and insurance costs to spike for everybody, no matter where your final port is.
And this is that critical mechanism you mentioned earlier. A severe non-monetary inflationary shock that Nepal Russia Bank has absolutely no power to fight.
Precisely. Look at what happened after the pandemic with supply chain bottlenecks. A 20% spike in freight costs was normal. If that happens again because of a conflict, your monetary toolkit is useless.
Raising interest rates does nothing to lower the insurance premium on a container coming from Shanghai to Kolkata.
Nothing. And that wave of inflation flows directly into the landed cost of our most critical imports. We're talking fuel, cooking gas, fertilizer, construction steel.
Which is where the fiscal pain really hits.
A 20, 30, even 40% spike in import costs makes government subsidies for things like fuel completely untenable. The budget gets crushed. This leads to either painful cuts or price hikes that could risk social unrest.
And there's a second layer of risk here too, right? A political one for Kathmandu.
Yes, the foreign policy tightrope. As you have the U.S.-India bloc pushing for freedom of navigation and China pushing for access, the pressure on Nepal to, explicitly take a side is going to intensify.
Which raises our political risk premium.
And potentially scares off FDI that we desperately need. So yeah, the ice melting thousands of miles away suddenly becomes a direct driver of domestic price spikes and diplomatic headaches here at home.
It's a perfect transition to our third black swan, which might be the fastest and most unpredictable. Ghosts in the machine. The new synergy between AI and high-frequency trading. Now, HFT isn't new. What's changed?
It's the marriage with generative AI, the dynamic self-learning kind. Old HFT followed strict pre-programmed rules. These new AI systems are, for all intents and purposes, black boxes.
So not just following orders.
No, they're dynamic. They're constantly re-optimizing. They're taking in a massive data stream, not just market data, but satellite imagery of ports, social media sentiment, and they autonomously generate and execute completely new trading strategies in milliseconds.
So the risk isn't just the speed anymore, it's that we don't know why it's making its decisions.
That's the core of what we call algorithmic fragility. Imagine thousands of these AIs, all independently trying to find a micro advantage. Now, what if a single flawed piece of data gets introduced? Maybe an AI-generated fake news report about a recession or a manufactured geopolitical incident.
Multiple AIs might misinterpret that same signal all at the same time.
And they don't wait for a human to double-check. They're built for speed, they execute.
And you get emergent, herd-like behavior.
A cascading loop of massive sell orders, triggering a flash crash that would be far deeper and faster than the one in 2010. It could literally vaporize trillions before a human trader even sees the chart move.
Okay, so the Dow plummets 3,000 points in 5 minutes. What does that mean for Nepal? Our stock market, NEPSE, has almost zero direct technical exposure to HFT.
And that assumption that no technical exposure means you're insulated, that is the critical blind spot. The threat here isn't technical at all. It's purely psychological contagion.
Our market is dominated by retail investors, and they are extremely sensitive to global headlines.
Exactly. Your average Nepali investor isn't doing a deep dive on balance sheets. They wake up, they see a panicked headline, "Global markets crash after AI glitch." The fundamentals of a local bank might be solid, but that nuance just gets lost.
And the immediate reaction is to sell.
Visceral panic selling in Kathmandu. It doesn't matter what the domestic fundamentals are.
What about our defenses, circuit breakers?
They're completely inadequate for this. A circuit breaker halts trading. It doesn't halt the underlying panic. When trading resumes the next day, the crisis of confidence just picks up where it left off.
And the long-term damage of that.
It's crippling. It doesn't just wipe out the wealth of small investors overnight. The crisis of confidence that follows could make it impossible for good Nepali companies to raise equity capital for the next 18 to 24 months.
So we have 20th century defenses for a 21st century AI-driven crisis.
A crisis that executes in milliseconds. That's the stark reality.
Okay, this makes the need for preparation incredibly urgent. So for the CEO, the investor, the policymaker listening, what are the clear signals they should be watching for? Let's quickly review the scenarios.
Right, we isolated 3 specific indicators. For the credit freeze, scenario A. You need to watch for a sharp, unseasonal, say 10% quarter-on-quarter drop in remittances. That's your canary in the coal mine.
And when you see that,
Expect the government to bring in drastic import restrictions almost immediately, just to preserve foreign currency.
okay, and for the Arctic standoff, scenario B,
Don't watch local inflation, watch the international logistics indexes, the Baltic Dry Index. If you start seeing freight surcharges of 25, 30, 40% hitting your importers, you know a severe non-monetary inflation shock is on its way.
and that makes subsidies for things like fuel and fertilizer fiscally impossible.
And risks social upheaval. Finally, for the algorithmic crash, scenario C, the indicator is purely psychological. The day after a major global flash crash, you watch NEPSE. If it hits its negative circuit breakers right at the opening bell,
Then the contagion has taken hold.
and that signals the start of a long crisis of confidence. Raising equity capital will be nearly impossible for the next couple of years.
So pulling all 3 of these incredibly high-stakes threats together, what is the final hard truth from the source material?
The hard truth is this. Nepal's current economic resilience is almost entirely dependent on global stability in 2 areas: remittance flows and trade logistics. That's it. Our current policy toolkit managing money supply, tinkering with trade deficits, it is fundamentally misaligned with these huge external shocks.
So the biggest risk isn't a normal downturn, but a complete paradigm shift. The sources have a great line for it. They say Kathmandu is meticulously waterproofing the house against rain, while a tsunami forms just over the horizon.
The strategic imperative has to shift. Stop worrying about if a black swan will land and start understanding the mechanism by which it will hit us, because that mechanism is the only thing that will tell you how to respond.
That is the critical takeaway.
And one final provocative thought for you to explore as you process all this. We talked about the growing competition over those Arctic routes between the US-India bloc and China. These routes are reshaping global supply chains. So the question is, how will Nepal manage the economic and diplomatic fallout when that competition forces an explicit choice? When it fractures the alliances of our giant neighbors and demands a strategic balancing act unlike anything we've ever had to do before?
That is something critical to mull over as you finalize your strategy for the new fiscal year. Thank you for diving deep with us.
We will see you next time.